Something happened last month that most people completely misread. One of the most powerful financial institutions on the planet put out a report about gold and silver, and the financial media ran with only half the story. Headlines screamed about gold hitting record highs, about a new era of commodity prices, about a rally that was reshaping markets. But buried in that same report, almost like an afterthought, was a silver statement. A statement that, if you understood what it actually meant, would have immediately told you where the real opportunity is sitting right now. Not in gold, in silver. And the irony is, the same institution warning you about silver's volatility is the one whose analysis confirms that silver could be the most explosive trade over the next 2 years. If you've ever been told just to buy gold and ignore silver, stay with me for the next 11 minutes, because what we're about to break down changes that entire conversation. This is one of those videos where you'll want to watch every single minute, because the pieces only come together when you see the full picture. And before we go any further, if you're new here, this channel, Element Axis, is built on one principle: no hype, no cheerleading, no doom and gloom, just real analysis, both sides of every argument, so that you can walk away and make your own informed decision with your own money. If that sounds like something you need in your financial life right now, hit that subscribe button. It costs you nothing, and it means you never miss a breakdown like this one again. All right, let's get into it. Let's start with where we actually are in the market, because the numbers matter and most people simply don't have them right. Gold recently peaked above $5,500 per troy ounce. That's a record. That's a number that would have seemed like science fiction to anyone watching gold trade at $2,000 just a few years ago. As of the latest data, gold has pulled back and is trading around $4,930 an ounce. Still up roughly 17% on the year. That's not a crash. That's a healthy consolidation after a historic run. But here's where the story gets genuinely interesting. Silver peaked above $121 per ounce in late January, and now it's sitting around $75. That's a decline of roughly 38% from the peak, 38%, in a matter of weeks. Now, to someone who doesn't understand what's driving this, that looks terrifying. That looks like a collapse. That looks like a reason to run. But to someone who understands the actual mechanics of what's happening in the silver market right now, that 38% decline looks very different. It looks like an opportunity. And that distinction between what something looks like on the surface and what it actually is underneath, that's what this whole video is about. So let me tell you what a major Wall Street bank actually said. Their senior commodities analyst made a very specific statement that I want you to hold on to. She said that gold's rally is not a sign of a commodity supercycle. She was very clear about that. This is not the beginning of some broad explosion in commodity prices, where everything from copper to oil to silver just rockets higher forever. That's not what's happening. And they went further. They said gold is something you cannot simply ramp up. You cannot scale it. You cannot just decide, because prices are high, to flood the market with new supply. The production constraints are geological. They're real. They're permanent. And that's why gold can sustain higher prices in ways that other commodities simply cannot. Other commodities, such as copper, aluminum, nickel, when prices go up, miners and producers respond by increasing supply. More production eventually catches up to demand. Eventually, the price increase carries the seeds of its own reversal. Gold doesn't work that way. The mines are where they are. The ore grades are what they are. Opening a new gold mine from scratch can take a decade. So when demand rises, supply can't chase it. That's structurally bullish, and they acknowledged it directly. And their end target, $5,400 per ounce by the end of 2026. That means they're not calling a top. They're calling a consolidation period followed by another leg higher. That's a bullish call dressed up in cautious language, and most people reading the headlines completely missed it. Now here's where I want to slow down and really focus, because this is where most of the analysis out there completely drops the ball. While everyone was busy talking about gold's record high, there was this quiet, almost technical sounding phrase buried in the same report about silver. A liquidity squeeze, two words that, if you've never heard them before, might sound boring, might sound like Wall Street jargon. But I want to break down exactly what those two words mean in the context of the silver market right now, because they explain everything. They explain the $121 peak. They explain the drop to $75. They explain why the volatility is going to continue. And they explain why, for the long-term investor, this creates a setup that doesn't come around very often. A liquidity squeeze happens when there simply isn't enough of something available to meet the demand that's coming for it. In silver's case, this is happening in London, which is where global benchmark prices for precious metals are set. Think of London's silver vaults as the central warehouse for the world's silver trading. When traders want to buy and sell silver contracts, when institutions want to hedge positions, and when large-scale demand hits the market, London is where it flows through. Now here's what we know about those vaults right now. Approximately half the silver currently sitting in London's vaults is already spoken for. It's already committed. It's already allocated to someone or something, which means the tradable, available silver, the silver that can actually change hands when someone wants to buy, has already shrunk dramatically just from that one fact alone. But then add a second layer on top of that. Because of concerns about potential tariffs in the United States, traders began moving physical silver out of London and into the US. Metal that was sitting in those London vaults, metal that was at least theoretically part of the tradable float, started leaving, getting transported across the Atlantic, getting locked up in US warehouses, and suddenly the amount of silver available in London to actually trade became extremely constrained. Half already committed. More moving to the US. The remaining tradable pool is tiny. Now, picture investor demand picking up at exactly that moment. Picture more people wanting to buy silver contracts, wanting exposure, wanting to take positions. And there's just not enough silver readily available to absorb that demand smoothly. What happens? Prices spike violently, rapidly, in ways that seem completely disconnected from the broader fundamentals. And then when that wave of demand pauses, when people stop buying, when some positions get closed, when sentiment shifts even slightly, prices crash just as violently. Because there's no cushion, there's no buffer of available supply to smooth out the selling either. This is what took silver from $75 up to $121, and then back down to $75. And according to the same institution that identified it, this dynamic is not going away anytime soon. The conditions creating the squeeze, the committed supply, the metal moving to the US, the constrained available float, those conditions persist, which means the extreme volatility persists. Now, I want to ask you something. And I genuinely want you to think about this before you move on. If you heard that an asset just dropped 38% from its high, your gut instinct might be to stay away. And that's a completely natural reaction. That's how most people are wired. We associate falling prices with danger. We associate volatility with risk. But what if the reason for that 38% drop is not because the asset is fundamentally broken, but because the mechanism that sets its short-term price is broken? What if the problem is not with the asset, but with the plumbing? The way silver is priced in the short term runs through a system, through vaults, through contracts, through available supply for trading, and when that system gets squeezed, prices move in ways that have nothing to do with long-term value. The squeeze took silver to 121. The same squeeze took it back to 75. But the underlying physical reality of silver, the industrial demand, the monetary demand, the supply constraints, none of that changed between January and now. None of it. What changed was the available tradable float in London. And that's a very different kind of problem than a fundamental collapse. Drop a comment right now and tell me what you think. Does that distinction change how you're looking at silver? Have you been watching these price moves and assuming it was a demand problem when it might actually be a supply plumbing problem? I want to hear from you. The community here at Element Axis is sharp and your perspective genuinely matters. Now, let me talk about what's actually driving gold higher over the medium and long term, because this matters directly for silver too. The analysis identified 3 specific forces, and I think all 3 deserve your attention. The first is central bank buying. Central banks around the world, China, Russia, Poland, Turkey, India, and others, have been buying gold at a pace that is historically extraordinary. And I want to be clear about why this is different from typical investor demand. When a central bank buys gold, they're not looking to flip it for profit in 6 months. They're reallocating strategic reserves. They're making a long-term decision about how to hold the wealth of a nation. These are not speculative purchases. They are structural. They are deliberate. And they create a consistent, stable bid underneath the gold market that doesn't evaporate when prices dip. Central banks don't panic sell when gold corrects. They often buy more. This structural demand changes the entire equation for gold pricing, and it shows no signs of slowing down. The second force is Federal Reserve rate policy. When interest rates are high, holding gold has a real cost. You could put that same money into a treasury bill and earn 5%. Gold pays nothing. It just sits there. So you're giving up that 5% in exchange for holding gold. That's the opportunity cost. But when rates come down, that calculation changes. 3%, 2%, 1%. Suddenly the opportunity cost of holding gold is much lower. Gold becomes more attractive relative to cash and bonds. The direction of travel for interest rates in the United States is lower. Not immediately, but the trajectory is clearly downward. Inflation has cooled to 2.4% year over year. The pressure for the Fed to keep rates elevated is easing. And when those cuts come, and they will come, every fraction of a percent lower is a tailwind for precious metals. The third force is what the analysis called the debasement trade. And I want to spend a real moment on this one because it's the most important for your age group, for people in their late 40s and 50s who are thinking seriously about retirement, about purchasing power, about what their savings are actually going to be worth in 10 or 15 years. The debasement trade is simple in concept. It's the recognition that the US dollar is losing purchasing power over time because of the sheer scale of government debt and deficit spending. US federal debt is above $36 trillion. Deficits are running at historically high levels year after year. There is no political will on either side of the aisle to meaningfully address that. The arithmetic is straightforward. When you keep spending dramatically more than you take in, you either borrow more or you inflate your way out of it. Both options are damaging to the purchasing power of the dollar. And when the dollar loses purchasing power, hard assets, things that have physical reality, things that cannot be printed, tend to hold or increase their value in dollar terms. Gold is the oldest, most established hedge against currency debasement in human history. Silver runs a close second. The fact that a major Wall Street institution explicitly named the debasement trade as a key driver of gold demand, that's not a fringe idea anymore. That's institutional validation of something that many thoughtful investors have been concerned about for years. If you've been watching government spending and wondering what it means for the value of your savings, you're not alone. And you're not wrong to be concerned. Now, here's the connection that most people miss entirely. Gold and silver tend to move in the same direction over time. The forces driving gold, central bank buying, rate cuts, the debasement trade, those same forces are working in silver's favor. But silver has something gold doesn't have. Silver carries massive industrial demand layered directly on top of its monetary demand. Solar panels, electronics, electric vehicles, medical devices, semiconductors. Silver is consumed in extraordinary quantities in the technologies that are supposed to define the next 2 decades of economic growth. The global push toward clean energy, toward electrification, toward advanced manufacturing, all of it eats silver. And here's the supply side of that equation. Silver mining is not keeping up. The world has been running a silver supply deficit, meaning combined industrial and investment demand is exceeding new mine production. And that structural imbalance doesn't resolve overnight. You don't build new silver mines on demand. The geological reality is fixed. So you have monetary demand, you have industrial demand, you have constrained new supply. And right now, on top of all of that, you have a liquidity squeeze in London creating a violent but temporary distortion in the price. All of those things together point in the same direction for silver over the medium to long term. The short-term volatility is the part that scares people away. And that's precisely why, for those who understand the mechanics, it creates an entry point that doesn't exist in calmer markets. Let me give you the technical picture on silver because it matters for timing, even if it doesn't change the fundamental thesis. Silver is trading around $75. The 20-day exponential moving average, a short-term trend indicator that traders watch closely, is sitting at $84.23. Silver is trading well below that level, and the average itself is sloping downward. That's a near-term warning sign. The relative strength index, which measures momentum, is sitting below 50. Below 50 means momentum is more negative than positive. Put those pieces together, and the near-term picture is this. Rallies in silver are likely to face selling pressure at key levels. The path of least resistance in the short term is sideways to lower. The level you need to watch is $84.23. If silver can close a full trading day above that level, not just an intraday spike that fades, but an actual sustained close above it, the short-term picture begins to shift. If the momentum indicator climbs back above 50 at the same time, that's a meaningful signal that the selling pressure is easing and a real recovery could take hold. Until that happens, patience is the right posture technically. But here's the nuance I always come back to. Technical analysis tells you about momentum and positioning. It tells you where the short-term pressure is pointed. It does not tell you about fundamental value. The best buying opportunities in markets very often occur precisely when the technical picture looks its worst, but the fundamental case remains strong. When everyone's scared, when the charts look ugly, when the price has dropped hard, that's when the risk-reward starts to shift toward long-term buyers. I'm not telling you to jump in tomorrow. I'm telling you to understand what the chart is showing you, understand what the fundamentals are telling you, and make your own decision about how to weigh those two things based on your own goals. Leave a comment and let me know. Are you more of a technical trader, someone who follows charts and levels closely? Or are you more of a fundamentals investor, someone who focuses on the underlying drivers and holds through volatility? It completely changes how this analysis applies to you personally, and I'd like to know. There's also a wild card sitting in the background that could change everything very quickly. Geopolitical tension, particularly involving the United States and Iran, is something the markets are watching carefully right now. Reports indicate serious military preparation for potential operations that could last weeks. This is not idle speculation. This is documented preparation for a scenario being taken seriously at the highest levels. If military action occurs, if escalation happens in the Middle East, financial markets would react immediately. Investors would rush to safe haven assets. Gold would spike, silver would follow. The geopolitical premium that is currently not priced into precious metals would appear very quickly. This is asymmetric risk. You're not paying for it at current prices. If it doesn't happen, no harm done. If it does, the upside could be significant and fast. I want to be clear, I'm not hoping for conflict of any kind. But as investors, understanding the full landscape of factors affecting your assets is essential. And this is one of them. Now, let me give you the bearish case because you deserve both sides and I never present only one. The gold rally could be closer to exhausted than people realize. The institutional end of 2026 target of $5,400 is actually below where gold peaked last month at $5,500. That means even the most bullish institutional view points to a modest move from here and potentially years of sideways action for those who bought near the top. Then there's the silver squeeze risk. If the London situation resolves, if metal flows back, if tariff fears ease, if the constrained supply normalizes, prices could come right back down. Silver could see $70, it could see $65. The $64 level was the recent panic low, and that's not some distant worst-case scenario. The options market dynamic also cuts both ways. The call buying that helped accelerate silver's rise creates a feedback loop that runs in reverse when sentiment shifts. Dealers who were buying metal to hedge calls suddenly have to sell when those positions reverse. The move can be fast and brutal. Central bank buying programs won't last forever either. When the biggest structural buyer steps back, prices lose a meaningful pillar of support. And if inflation continues cooling without new fiscal crises emerging, some of the fear premium in precious metals fades. These risks are real. Anyone telling you precious metals are a guaranteed one-way trade is not being straight with you. The question is always whether the reward justifies the risk and whether the fundamental drivers are durable enough to carry the thesis through the inevitable difficult periods. So how do you think about positioning given everything we've covered? I want to give you a framework, not a trade recommendation, because everyone's situation is different. For the long-term holder, someone thinking in years rather than weeks, today's analysis doesn't break the fundamental thesis. Central banks are buying. The debasement trade is structural. Silver has dual demand and constrained supply. The liquidity squeeze is a mechanical short-term problem, not a fundamental one. Long-term holders accumulate on weakness. They don't panic when prices dip. They understand that volatility is the admission price for long-term returns in this asset class. They scale in over time, building their position at different price levels. For the short-term trader, someone watching charts and trying to capture swings, the message is completely different. Silver's volatility right now is extreme. Leverage is dangerous. Position sizing is critical. Stop losses are not optional. The same dynamics creating massive upswings can reverse into massive downswings with very little warning. Discipline is everything. For someone on the sidelines wondering whether to start a position, current prices are meaningfully below recent highs. Gold is off its record. Silver is down 38%. If the thesis is right, these are better entry points than we've seen in months. But scale in. Don't go all in at once. Let the volatility work for you by giving you additional opportunities at lower levels. And if you're genuinely skeptical of the whole precious metals story, watch the data. Watch what central banks actually do. Watch US debt and deficits. Watch the Fed. The thesis is evidence-based. If the evidence changes, the thesis changes. That's how it should work. If this breakdown gave you value, take 2 seconds and share it with one person who's been watching these markets and trying to make sense of them. A friend, a family member, someone at work. One share from you could genuinely change how they're thinking about this. That's how communities of informed people grow. Let me leave you with the key levels to track as this story develops. For gold, $5,000 is the key psychological support level. Below that, $4,800 is the next meaningful floor. Above $5,000, the path points back toward $5,500 and then toward the institutional target of $5,400 by end of 2026. For silver, $84.23 is the near-term resistance to watch. A sustained close above that level changes the technical picture. Below current prices, $70 is round number psychological support. Below that, $64 was the recent panic low and the last meaningful technical floor before conditions become significantly more difficult. Above 84, $90 becomes the target, and then 100. The setup for a move above 100 is being built by the same fundamental forces we've discussed today. Not guaranteed, not immediate, but the conditions are developing. Here's what I want to stay with you after this video. The institutional analysis on precious metals right now is nuanced in a way that most coverage completely misses. What sounds like a cautionary statement, no commodity supercycle, is actually paired with a clear bullish position on gold specifically. The reasoning is precise and worth understanding. Gold's supply cannot respond to price signals the way other commodities' supply can. When demand rises and supply cannot follow, prices sustain higher levels. Simple, powerful. The silver story builds on that gold thesis and adds a layer. Half the available silver in London already committed. More metal moving to the US, the tradable float shrinking. Demand hits a constrained market. Prices explode in both directions. That's the liquidity squeeze. And it's not resolving soon. The macro environment provides the backdrop. Inflation cooling, but rates staying up near term. Geopolitical wildcards creating potential sudden safe haven demand. Rate cuts on the horizon as a medium-term tailwind. Central bank buying providing structural support. The debasement trade continuing to drive demand from people who are genuinely worried, and reasonably so, about the long-term purchasing power of their savings. None of this resolves in a week. These are structural forces playing out over years. The path will be volatile. There will be more 38% drawdowns. There will be periods where everything looks broken, and the headlines are terrifying. Only those who understand the actual mechanics, who have genuine conviction rooted in real analysis rather than hope, will hold through those periods and be positioned when the moves happen. Know which game you're playing. Build your strategy around your time horizon and your risk tolerance. Stay anchored to the data and update your thinking when the data changes. That's how you stay ahead of this. That's what Element Axis is here to help you do. Subscribe, so you're here for the next breakdown. Like this video if it helped you see the full picture rather than just the headline, and share it with one person today who needs to see it. Stay patient, stay informed, and we'll see you in the next one.